Things changed today. While we were really shaky earlier this week, things have changed today with a signal on the market forecast indicator that's telling us a really interesting story. So I'm going to break down what that signal is, what it's telling us, how we got it. I'm also going to break down, again, a speculative trade in a hot sector right now with an earnings announcement coming up, how we can manage the risk of the earnings as well as the volatility changes. So let's go ahead and get started. Today is Friday, August the 3rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you watching us for the first time. Glad you found this. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo in the bottom right corner of the video. Click the red subscribe button that pops out there. Also, click the thumbs up icon that's down below the video. That lets me know two things. You like the video tonight, you want us to keep doing it. Really easy way to give us feedback. Comment on anything that stands out to you. We want to hear from you down in the comment section down below. There's a link popping out in the top right corner of your screen. Click that link to subscribe to our daily Market Outlook email list. Follow on Twitter for more content like this throughout the day, and join our Market Outlook community on Facebook. All right, let's start off taking a look at the S&P 500 here with the market forecast indicator. As you can see, it finished today pretty well with an overbought cluster. Now, I want to break down what that overbought cluster means. That red dot you see here with all three lines, almost all four lines with the market sentiment line almost getting above 80. This is the second overbought cluster we've gotten since this intermediate run started back at the beginning of July. So we're almost a month into this intermediate run. That typically lasts 1 to 3 months, and we've talked about 2018 going to be a lot more volatile than 2017, which means we'll probably get more intermediate runs that are shorter in length than what we saw last year, where it was just grinding for months higher. We had a 4-month run, we had a 5-month run, very, very long runs that both culminated in some big moves that led to some extended intermediate pullbacks that everybody thought the world was going to end. But here, just last week, things were looking pretty shaky on stocks. I mean, even as of yesterday morning at the open, we were opening down low, and a lot of people thought we were bearish. I mean, I hear it all the time because apparently I'm not bearish enough on the markets. And so when the futures are down, I hear it from people about how, I should be more bearish apparently. But we rally by the end of the day, and today we finished higher because that's the path of least resistance is to the upside. Market sentiment's rising. We are back to a strong bullish posture with the intermediate line getting above 80. So that's the first line to get the red dot. The second line is that momentum line. See, we had a weak bearish posture as of yesterday. The intermediate line was falling. It had finally dropped below 80, which signified a change to a weak bearish posture. But the momentum line spiked with yesterday's move, and then it spiked even higher today, almost to the 100th percentile. That's a pretty good move that would suggest that we are changing from bullish to bearish. You can see we got this similar spike back here. Now, eventually we pulled back a little bit on a near-term basis because we were already, what, seven days or so into that near-term run. So we talked about, in fact, it was how many days? It was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days into the near-term rally by the time we got the cluster. So, we talked about, okay, well, that cluster, good sign for the intermediate trend, that we might get like a 2-month run out of this. But from a near-term basis, because we were 10 days in, probably going to get a near-term pullback. Here, the near-term line is just barely starting. And the near-term line just barely got above 80, got further above 80 than we did any of these other peaks that you see here. Very good sign that things are doing. Now, we're not up to a higher high yet. That would be kind of the next thing we need to see. But we expect to see that now that we got this cluster that kind of shows that, it's not the same as a cluster that once you're 2 months, we're not even a month in to this intermediate rally yet. If we were 2 months in, especially 3 months in, we got a cluster like this, then we'd be worried about things. But the fact that we're still less than a month in, and this near-term run is just starting, and things were looking pretty shaky. This reverses the shakiness that we saw in the S&P 500 and gives us a better outlook heading into next week. Now, seasonally, this is not a good time in stocks. You know, if I were to remove all of these and look at the seasonality charts here for the S&P 500 and look at it as a percentage basis, you can see, you know, we might have a little bit of a run here to August the 14th, but then after that, into the end of the month, you know, it's downhill from there. So we might get another, you know, we're at what, August the 3rd right now, and August the 14th is 11 days away. We still have 11 more days that we could, you know, and that includes all of next week, that we can get a little bit of a run. And of course, we're just 2 days into this near-term rally, so that could very well just be the near-term weakness at the end of this current, near-term run. So that's what we're seeing. That's a good sign for the S&P 500, which kind of, again, for those of you who are familiar with this indicator, who may have, you know, hear about other people talking about this indicator, that's usually termed a bearish cluster. In this case, that would not be bearish. In this case, it's actually a good sign to get one. It would kind of, you know, again, like I said, reverses the shakiness that we had up until yesterday's open. And solidifies this bearish run that we're currently on. You can see the shadings turn green again because the intermediate line has turned higher. The Dow Jones Industrial Average, you can see closing above yesterday's high, so a good bounce there. The near-term line coming up off of a bullish low point, a low in between 20 and 50. That corresponds to a higher low on the chart. So things are bouncing back, and not in the reversal zone yet. But you can see the momentum line, the red line, did spike back up above 90. Remember, 90 is the extreme level on the upside because stocks don't typically go up as strongly as they go down. The fifth percentile is extreme low on the downside. So we did get an extreme low here. That's, again, things are shaky, but looks like things are turning back around. Now, they were shakiest on the NASDAQ. NASDAQ had a good, nice bounce here. Let me get rid. Well, here, let's leave those on because you can see the NASDAQ did pull back the Fibonacci retracement. And we talked about, even on that day, we talked about we got to hold this. We expected to hold it because we expect support to hold until it doesn't. But if it didn't, then the narrative changes, right? And lo and behold, we did end up holding, and we bounced up really good yesterday and continuing higher so that the intermediate line has turned green again. So we never did get the dark pink shading on the NASDAQ, which signifies the end of the intermediate run. We did get some light pink, so weak bearishness, but the intermediate line turning back up above 50, near-term line getting back in the reversal zone to solidify that posture change. Remember, 7 to 12 days is what you expect, along with a higher high. The Russell, of course, has been the shakiest, and you can see it had ended this intermediate run very quickly. We didn't have a very long run at all. We did not get up to a new intermediate high point, but we also didn't break down to a new intermediate low point either. So a little bit of a consolidation range on the Russell 2000 with the potential to break out. Remember, the Russell 2000 was the most bullish. We had 4 overbought clusters in a row. That's rare to get a cluster of overbought clusters. Typically, you get a cluster of oversold clusters. So we were so strongly bullish on the Russell 2000 that it's had more consolidation. I showed this chart today in our technical analysis class. IWM on the 3-month basis is up 6.88%, so that puts it about right in between here, MDY and IVE, and only because it's down today 0.5%. Where is it? IWM up here. It's down, but also keep in mind that that number was a lot higher. In fact, that number was up in the double digits here, the 3-month return. So the Russell had more gains to consolidate than any of the other indexes have, and so its consolidation is lasting longer. But if that's the consolidation without lower lows, that's a good consolidation, right? It's the pullbacks that drop down deeper. That's the ones that we concern ourselves with. Of course, here, let me get rid of that Fibonacci retracement. Snap these. drawings here and get a new Fibonacci retracement from over here up to these highs, and you can see that intermediate pullback did get us down to 38% Fibonacci retracement, and then we're still in that range. So we haven't even gone into that retracement zone yet, much less through it, which is where we'd be concerned about any bullishness that we'd have left. So we're still up here, still good potential to break through and continue to trend higher again, even with market sentiment falling, showing a weak posture there. Obviously still easily up above 50. All right, now really quickly a reminder that you can also watch our Market Outlook videos here on our marketscholars.com on our blog. Click on the blog up here at the top. You can also see too that I have a Q&A session coming up for our premium subscribers to our site tomorrow morning at 10 a.m. Eastern. So if you have any questions, those of you who are watching the Market Outlook tonight on what we're talking about here, I can spend some more time and answer directly your questions there in that Q&A session. For feedback, for us to see whether you want us to keep doing these Market Outlook videos, we ask for 3 clicks. One, to like the Market Outlook tweet. It's embedded here. You can do it right now. Just scroll down here below the video. Remember, there's that link in the top right corner that will take you here if you're watching this on the YouTube site. But click on that like button that will like tonight's Market Outlook tweet. Click on this icon that will take you to your Facebook page where you can like it, like the post there as well. You can see eventually it will pop up here. There we go. You can like it there. Or you can also click right here. So those 3 clicks are 3 ways you can do, again, right now while you're watching, to let us know, hey David, I liked the video tonight. I want you to keep doing these. Okay, so back to the charts, and you can see, we're continuing. We're still above. We got a higher close, and we've had 5 weeks in a row where we've closed higher. We're above a rising moving average, 50-day moving average. We're above a rising 200-day moving average. The gap between the two is rising. So from a long-term perspective, you can't really be more bullish than that. So it's hard to be too bearish right now. Now we might think we're getting a little overbought, and we are. I mean, considering how long this golden cross has occurred. But that doesn't mean that we should start loading up on bearishness because we think that the market should be topping out. Right, we follow the trend until the trend shows, those signs of weakness. And if you look at the, 3 green arrow chart, you can see we're almost back to 3 green arrows. We never did get pink shading where you get 3 red arrows. Sometimes that only lasts like 1 day before you bounce back up when you're on good strong trends. This one lasts a little bit longer. You got a red line, so we are, a little bit more bearish, a little bit more of an intermediate pullback. But you can see we're back to 2 green arrows. So 1 on the moving average, stochastics turning back up again. And you can see the MACD histogram is really darn close. And you're back up above the 8-day moving average. That was the move yesterday after starting below the 17 and then back up above it easily today. And you can see the MACD closely crossing back up above its moving average as well with the stochastics, giving the phantom green arrow and also close to crossing above the moving average as well. So we got the potential here for a near-term run of typically 10 to 12 days again, heading right into that seasonal peak before things kind of fall at the end of August, where we have a couple of weeks of bearishness, typically. All right, as you take a look here at the S&P 500 on the intraday chart, so we're looking good on the long-term chart. We're looking good on we're looking closer to being better on the 3 green arrow chart. We have the, we're back to green shading on the market forecast chart. So intermediate and long-term looking better. And now on the short term, you can see too, looking pretty darn well. We're easily in the upper half of the chart. Now this line's going to start moving tomorrow or Monday. We're going to be right there. So that line's going to move up kind of into this area, the midpoint. So, we're easily in the upper half of the chart now, but that's not going to be the case on Monday. And then that's going to be, for a few days, that will be the low point until we move up to that, to what is now the midpoint. That will be the 4-week low point. So that's going to end up being a really tight range if we don't break out. So this is a sign, in my opinion, that we are going to break out to a new 4-week high point next week. If we don't, and we move by the end of the week, the 4-week low point moves up to where this dotted line is now, then that's not going to be a good sign. Because usually, because the midpoint then will move up to about right here, right in that area, and we'll be really close to breaking through. And when the range tightens up, that usually precedes more of a bearish move, which we expect. Again, it's not going to be a big deal, but it precedes more of a bearish move. So because of that, I do think that we'll break out of this 4-week range and get new 4-week high points next week. If we don't, it wouldn't be the first time I'm wrong, but that's what I'm expecting based on the other charts we've been seeing and the fact that this is going to start moving up. And I don't think we're to the point yet where the range should be tightening. So as this moves up, the top line will probably move up a little bit too. Not to the same extent, but it'll probably end up moving up a little bit too. All right, so now let's take a look at, really quickly, this chart. Go back to the 3 green arrows, and we'll look at SPY. And you can see the range was well below average, 1.33 points. The volume at 54 million again, so very similar volume to what we saw before a couple of days ago. So very low volume, 54 million shares is well below the average, right there, right in that area. So you can see how it compares to the 52-week range. The average range on an absolute basis, 1.33, well below the average, and you can see also towards the lower end. So that's actually bullish in both those cases. And then the ATR, the relative ATR, the ATR to the price, when you compare this number to what's up here, it's below 1%, and that's a bullish territory. Obviously, being above it, 1% is more bearish territory. So good sign for the markets in that respect as well. Finally, you take a look at the volatility, and you can see we dip back down and drop back below 12, and that's, again, that's where the low point has been lately, is 12. So getting to 11.5 is really bearish, getting to new lower lows, coming down from slightly lower highs. And then if you look at volatility on a relative basis, which is really the most important, it's extremely low. So it's still in bullish territory, and it's not below 80%. That's where it's really extreme. But it's getting close. So, again, I expect bullishness next week, but we are heading into that August, 14th time frame where there's typically a drop in the S&P and a rise in volatility. And when we get really extreme like this, it's good if you're trading options inventory, like we talk about, and you're kind of adding a lot of positions. This is a good time to start adding some calendars to your inventory. For example, if you put a lot of positions on SPY, some of these big index ETFs, now's a good time to add that. With volatility this low, you would expect it would start to rise from these lows, at least in the next few weeks, within the time frame of what you would normally put a calendar on. So what do you think about the market posture? There's a poll popping out in the top right corner of the screen. Click on that link up there and then hit on agree or disagree. Do you agree with what we're talking about here, with this bullishness heading into next week, with a peak looming on the horizon, or do you think we should be more bearish right now? If that's the case, click disagree. Let me know what you're seeing. Maybe you see some of the chart that we haven't discussed here. Maybe you see something, some indicator or relationship or whatever that we haven't brought up. Scroll down below in the comment section and let us know there. Remember, you can also comment on the marketscholars.com with the link that's right above the video that you might be watching through our blog. There's a link that will take you directly to the Market Outlook forums. Remember, you have to subscribe. You can do it for free, but you have to subscribe to our site to participate in the forums. But love to continue that conversation there as well. All right, now let's focus on what's driving the price action now that we are through our market posture. And let's talk about what's driving it today to get us to this point. And of course, the two biggest factors today that drove price action was the two biggest factors were the jobs number early this morning, as well as the China tariffs on $60 billion of our goods. Normally, that would be bearish for the markets. You would expect. That has been bearish in the past. The jobs number didn't meet expectations, came in a little bit below. You'll see that here in a second. and then the tariff news. But you notice it didn't stop the S&P 500. The Russell 2000 pulled back a little bit. But look at by the end of the week, the S&P was your best performing market. Look at emerging markets and developed markets, international stocks ended up the week down 1%, with U.S. stocks rallying. Now, small cap stocks did give up some gains. Remember, they have more gains to give up lately, but you can also see here too, high yield bonds doing well. The dollar was strong this week, very strong move on the dollar this week, putting pressure on gold, putting pressure on crude oil, and you can see bonds actually rallied today. In fact, pretty much everything rallied. If you look at over here on these asset class watch lists, everything rallied today. And look, here's a real estate stocks, VNQ, dividend stocks, preferred stocks, MLPs. I mean, different types of equities across the board rallied. And then you can see all bonds rallied too. Mortgage, municipal bonds rallied, long-term treasuries rallied. Here's the foreign bond market. It rallied. High yield bonds rallied. And then down here you can see the dollar rallied, which is still putting pressure on gold, down 7% in the last 3 years. Agricultural commodities, they did bounce today, and they have a weak bullish posture developing, but still down 10% on the 3-month. And crude oil, you can see kind of flattening out here, not really making much of a move one way or the other, down below an upward trending moving average. So not really green there. All the rest of these, I mean, green moving average, green here. Preferreds have been a little bit weak. It had a little bit of breakdown this week and starting to bounce back up. And bonds, kind of an oversold bounce. But you can see everything did, except for international stocks. Everything did well. And EEM did okay. But developed markets like Germany especially, you take a look at the German markets here. The German markets bouncing up a little bit. They lagged behind. There's Brazil, Mexico we've thrown in there. Not one of the 12 biggest economies. So here's your 12 biggest economies here. Brazil had a nice move. It's been so down. But look at that. After all these clusters, we're getting an overbought cluster. Canada getting an overbought cluster. That's a positive development. Look at India taking off, looking better. France having a decent day today. United Kingdom up. There's the S&P 500. So, some of these Europeans didn't do as well relative to the U.S. and Japan and Russia still kind of lagging behind. There's Korea and China. I mean, these Asian currencies, they're the ones that are struggling the most with all these trade wars. And this was China actually putting on the tariffs today. And, of course, European markets too. But not everything is doom and gloom. There's some areas that are doing really well and showing the clusters, just like we're getting in the U.S., showing the clusters to really solidify that bullishness. Here's the currencies, and you can see how things are doing relative to each other in the currencies. Most everything down against the dollar except for the Australian dollar right here, bouncing up. And then, of course, the Japanese yen. You can see the dollar pulling back down against that, but the trend still the trend's still down for the euro, it's still down for the pound, it's still down for the Aussie and the Kiwi as well. And then you can see the dollar still either flat to a bullish for some of these. You can see it's bearish against the Canadian dollar. Another reason to be more bullish on those Canadian markets. And you can see all the others, these more exotics, really strong bullish trends. Down against the Mexican peso as well. So those two continue to be kind of the weaker areas for the greenback. While all the focus is on the Asia and Europe with these tariffs, our North American counterparts are really benefiting from the lack of news, and of course pulling back here against the South African rand as well. So the dollar is still strong. It's still had a great week, as you see on a lot of these charts. It had a really great week. And when a dollar is strong like this, it doesn't mean that we have to be bearish. It will limit upside returns, but it also will suggest that technology, discretionary, those tend to do better. Those tend to be the market leadership while we are in a rising dollar environment. And as you can see, pretty much broad broad-based rally too, except against those two. Speaking of sectors, here, let's switch this back to our watch list and look at the sector rotation for today. And you can see real estate stocks doing well, but look at, this is a risk-off kind of a day. The stocks were, IWM was down, and look how these safe haven sectors really bounced up the most. On the other hand, so there's the S&P 500. On the other hand, technology and discretionary lagged behind a little bit. So here, let's move to the sector chart here so you can see some of those. So here's our two market leaders, technology and discretionary, that we'd expect. You can see they are bouncing back up, and they're back to having bullish postures again. So they were pink shading for a while. You can see here, strong dollar also puts pressure on energy. Materials and industrials are impacted by the tariff wars. Financials bouncing back up, making a strong move higher. Healthcare continuing to be a strong trend. So, that's one of our market leaders that we've been focusing on. But look at the utilities, a little bit of a breakout move and a overbought cluster on staples. Wasn't too long ago that those two were so beaten up. And real estate. So nice, strong trends on a lot of these sectors, but in particular these safe haven areas. So we might see some of the rotation into these safer areas a little earlier than expected. We'll keep our eyes on technology and discretionary. Healthcare also can be considered safe haven at times too, except for the biotechnology. So we'll keep our eyes on those areas as long as they continue to show strength and the market's still bullish. If they start to show weakness and these areas continue to really outperform staples and utilities and real estate and healthcare, then that will be the sign that the market's rotating into safety ahead of expected weakness. Of course, one day doesn't make a trend, and so that's why I don't want to put a whole lot of stock into what we see today, but it definitely is something that makes us look and makes us say, okay, well, let's see if this continues to be the case, and if we start, especially if we start to see some relative weakness in technology and discretionary over a longer term than just the one day. All right, we've really been focusing on that healthcare sector, and today I wanted to look at that again because there's another stock showing 3 green arrows today with a jump in volume. Is Mylan. Now Mylan does, if I were to here, let's expand out the time frame here. Let's go 20 days. There is earnings coming up on this next week. So there is, we're a little bullish heading into that earnings, and you can see last year the earnings, we were to the point where we were already pretty low. We were already trending down, and we started the knee jerk to the downside before rallying up and pulling back, holding that support, and then making a run back off of those low points. So the low of after the knee-jerk low gap down after the earnings set the low point, and we rallied off of that. So every other earnings, we pushed up off of that. We pushed up a little bit off of that one, and we pushed up a little off of that. But it's kind of stayed within the range. But this is a pretty decent move, a little bit of a breakout move. Allows us to be a little speculative heading into this earnings announcement. So the way that we do that is you can say, okay, well, let's, if I were to buy a call option, if I were to buy this $40 call option kind of at the money here, relatively at the money, 37.5 is actually at the money with that higher extrinsic value. But if I were to buy that $40 call option, then the problem I have is it's a positive vega, and if volatility drops after earnings next week, it's really going to impact that $40 call option. But I can soften the blow a little bit by selling the 42.5 call option. That is negative vega, so that will actually benefit for me if volatility does drop. So now the price drops from $1.19 down to only 67 cents, but my maximum gain on this trade is $183 if we get up above 42.5. 42.5 being right in this area. So if we kind of make a run here, if this little breakout move gets amplified with that earnings, and we make a run up towards the top, even shoot, just getting above this 41.25 level, we can start looking, and my break evens at 40.67. So there's my break even. We just have to get above that level just to make anything, to get a 1-to-1 reward to risk ratio. but by expiration, you can see I'm looking about right in that area, this target area. So anything above 41 and a quarter, that I make more than up to 42.5. I make more than a 1-to-1 reward to risk ratio, all the way up to 3-to-1, almost 3-to-1, if it gets up to that 42.5 level. So it's a way to be a little speculative with that earnings announcement to get a decent reward to risk ratio. Assuming, with the big move that we've had today, kind of a little bit of a precursor. If that leads to a bullish move in a really strong sector right now, then we can take advantage and get a pretty decent return for a really low risk. $67 with minimal exposure to volatility change and time change for that matter. That if it breaks down, we know what we're going to lose. It's set at that $67, and if it takes off to the upside, we can easily make up that risk really quickly with a nice return. So that's my trade risk is $67 per spread plus commissions. So now it's the portfolio risk. I say, okay, if I'm normally willing to lose 1% on a trade, considering the earnings and the speculative nature of this trade, we'll probably put a lot less than that, like maybe 0.5%. So that if I were to lose maximum loss, which is $67 per spread, then how many spreads can I get in? What's my quantity here? How many spreads can I get in so that this number, like for example in this account, this if 1% is $1,000, then I can do 7 contracts. So my loss would be $469 within 0.5%. Really low percentage relative to my portfolio, but if it does take off and meets what we expect, then there's a potential reward for almost triple that, $1,281. All right, that does us for today. So let me know what you think about our trade idea. Let me know what you think about the market posture. Remember, there's a link right above the video that will take you to the Market Outlook forums. There's also a link popping out in the top right corner of your screen there that will take you there too. And let's continue the discussion in the forums. Let me know if you have any questions. Let me know if you have any comments about some of the things that we talk about, or if you want my perspective relating to the market posture on some things that you may be looking at as well. Remember, in a forum, it's not just back and forth between me and you. It's also opportunity for you all that watch this video to interact with each other. So you can answer each other's questions and comments as well as you see them there in the forum. So thank you again, as always, for watching our video tonight. Have a great weekend, everybody. We'll see you all on Monday. Remember to subscribe to our YouTube channel. Click on the thumbs up icon and comment. Also follow on Twitter and join our Market Outlook Facebook, Market Outlook community on Facebook. All right. Have a great weekend again, and we'll see you all next time.